Welcome to the Gold Newsletter Podcast, your bank of knowledge of investments, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives to increase your wealth monetarily and educationally.
This is Fergus Hodgson with the Gold Newsletter Podcast, joined by Brian London. We have James Grant, or Jim Grant, of Grant's Interest Rate Observer on the line. He has been in this business, or at least with his organization, since 1983, the year I was born, so you got some experience there. His books include works of finance, history, and biography. And there's a whole list there. We'll include these on the show notes. Go to goldnewsletter.com/podcast. Jim, welcome back to the show.
Fergus, nice to be here.
Great. Brian, you mentioned that we actually have a special deal on for the Observer, or for the Interest Rate Observer. Do you want to explain what that is?
Yeah, we had worked with Jim, and he's kindly offered a special opportunity for our listeners that if they subscribe to his newsletter, and we'll have the link in the show notes, they'll get the audio-video recordings from his big conference on October 9th for free. And that's just an incredible event, Jim. The people that you have, Stanley Druckenmiller, Bill Ackman, James Bianco, Edward Chancellor, goes on and on and on. It's just remarkable to me. And, you know, as host of the New Orleans conference, I'm very attuned to what it takes to put on an investment event. And you just do an incredible job of this.
Oh, thank you, Brian. Well, this is our 35th anniversary conference. And so people, I think, will get their money's worth. They will not get the live champagne toast to the readers of Grants, which will conclude the conference. But everything else is there for the watching.
Well, at 35 years, I guess that makes you the second oldest investment conference in the world, next to the New Orleans event.
Yes, well, I think you'll agree, Brian. There's much too much crowding in this field now. It seems like every third person and every sick child has his or her own investment conference. It's getting quite worrying. I think that the legacy people just simply must carry on.
We must. And, you know, I have lots of people that just exactly what you say, a number of colleagues in my little gold-oriented mining stock area of the market all of a sudden are having conferences. And I tell them...
Discourage them, please.
Yeah, I wish you would have asked me first, because it's... And I'm sure you feel this as well. Doing it so long, you have to keep doing it. But we've been doing this so long, we have to keep doing it. But I would discourage anyone from getting into the business, because it's just not a great business to be in. There's so much profit margins are just paper thin, the amount of time, effort, and resources. Plus, you have to, sign away a good portion of your net worth to a hotel and throw this big party and hope some people come.
Well, we sound like two farmers talking down the corn crop. So let's move on to something more constructive, shall we?
Absolutely.
Jim, you've been in this 35 years, or at least with your publication. I get the sense we're in uncharted waters sometime, or an uncharted territory.
Oh, yes, yes.
Do you want to comment just briefly on the fact that we still, even after a decade since the Great Recession began, we still are basically at near zero, if not even negative, real interest rates?
Yes, it is a singular world. There is a page-turner of a book called The History of Interest Rates. I suspect that, Fergus, you and Brian have copies by your bedside, as do I. And so the subtitle is 2000 BC to the present. So that's 3,000 years of history of interest rates. And you can turn those pages all day and not encounter an episode in which substantial volumes of sovereign debt, not treasury bills, but, proper notes or bonds, were quoted at nominal yields of less than zero. And today, even as you observe 10 years after the Lehman fireworks, there are no fewer than 6.9 trillion, according to Bloomberg, $6.9 trillion worth of sovereign debt quoted at less than nothing. That's one sighting, and another to drive home the point of the singularity of this moment in finance and rates. The 10-year Treasury note, U.S. Treasury note, traded, I think, on July 5th, 2016, slightly more than 2 years ago, at a price to yield a little less than 1.4. I think it was 1 3/8 or thereabouts. And that is the lowest sovereign yield of a major debt issuer, according to Bank of England study, since at least the the 13th century. So, yeah, uncharted, yes, and heretofore unimagined. You know, there was a great man of yesteryear. His name was Walter Bagehot, and he edited The Economist magazine in the middle of the 1850s and 60s, and I guess into 1870s. And it was Bagehot who coined the maxim that 2% is always trouble. It's always an incitement to do something stupid with money. And he meant positive 2%, of course. So ultra-low interest rates have always been kind of the catnip of speculation. And here we have had 10 years of rates oftentimes below 2%. And we've been storing up a lot of trouble.
Okay, so we don't see yet, perhaps, the inflationary pressure that may be to come, right? So, I mean, the reported inflation rates in the United States are still below 3%. Is that set to change?
I think so. That is an opinion. We all have one. But I think I see the coming out into the open of the latent inflationary pressures of the past several years. What we have certainly seen in the way of a visible inflation is the spurt upside to all manner of asset prices. You know, I have just come across a piece of research by Deutsche Bank. It came out, I think, on the 17th September. And this research is a long-term survey of asset prices with a focus on inflation. And here is something to consider with regard to the age in which we live. According to the analysts and the historians that Deutsche Bank has engaged for this project, it took 649 years for nominal house prices in the UK. They have the longest series of prices for UK house prices of any asset class. So it took 649 years for nominal prices to go up by 887%. That's until 1939. And that 880% rise over the course of about 650 years works out to 0.4% per year. All right, 0.5% a year rise over the course of about 650 years until 1939. Now, over the subsequent 79 years, that we're getting into the era in which we live, over those 79 years, since 1939, since the beginning of the Second World War, house prices have risen by something more than 41,000%, or 8% annualized. So this is truly, it's truly the age of inflation. It doesn't seem that way at the moment because inflation rates, for whatever reason, have been quiescent. But this is still the age of inflation, and I expect more of it.
You know, Jim, what I've found is there's an interesting dichotomy these days. We talk about uncharted territory and how so much of what we're seeing today is unprecedented. But on the other hand, we've seen this movie before, and throughout human history, over and over again, governments have overspent. They've overspent in wars or entitlements, bread and circuses, everything. And whenever that has happened, they've depreciated the currency. They cheapened the debt, in other words. It's been the age-old solution. It's been the only solution, and it's happened over and over again. And,
Yep.
It happened in the 2nd century in Rome when the denarius was depreciated by about 80% over about 50 or 60 years. Well, since they took silver out of the U.S. coinage, since we'd closed the gold window in 1971, the U.S. dollar's lost about 88% over a similar time frame. So it's very similar. These things have happened over and over again. But with that said, I guess the big difference today from anything we've ever seen before is that unlike a country or a nation state depreciating their currency to lessen the burden of their debts, today we have every developed country in the same boat across the world. So there's no way to get, for example, a trade advantage by depreciating your currency because everybody's racing to the bottom of the hill at the same time. So in that way, it really is unprecedented.
A central bank policy today and the thinking behind central bank policy is something new under the sun. Just as you say, Brian, very little in finance is ever truly novel. Derivatives in one form or another have been around for a long time. The ATM machine is, in fact, newish, but the cycles of lending and borrowing certainly are very familiar and would have been so to our forebears 200 years ago. The series of defaults by emerging market governments, these too are very familiar cyclical sightings, starting from about 200 years ago, 1820s. The Financial Times of London wrote something last week, the week before, up to Argentina, and the reporter said that some people in the market have had experience with prior episodes of this. And I thought to myself, in fact, wrote it in Grants, that yes, some people have had that experience. And furthermore, 16 generations of their forebears have had that experience. Something that is new yet ever so familiar in a historical sense is the credit cycle, is the cycle of lending too little, too timorously, too timidly, and then saying yes to everything, seemingly. So you go from bankers saying no to bankers saying yes.
Right.
Gradations in between. That's the credit cycle. So today, we are seeing, it seems to me, we are seeing the signs and the portents of a peaking in another credit cycle. We are seeing the most astounding excesses, particularly, it seems to me, in corporate debt. Anything goes in the realm of what they call leveraged lending. Leveraged lending, which seems like an oxymoron. All lending is leverage. It's all about debt. But lending of this kind, leveraged lending, is about tradable bank loans to speculative grade companies. And there's about $1 trillion worth of this stuff out there. And what is new and different in this particular cycle is that the fine print, the contractual language called the covenants that protects the lender to these companies, that language has been eviscerated or erased. So come the next default cycle, which will surely come, you're going to see a much different default experience and a much different return record put up by these loans. In 2008, you could hardly have done better than invest in the senior-most claim in a corporate capital structure. But that is yesteryear's experience, and tomorrow's experience will be much less favorable. So, Brian, to wind up my 15-minute speech on this topic, much is different, more is the same, or recurrent, or cyclical. That's the nature of finance.
For more than 40 years, top financial experts and private investors from all over the world have gathered for the New Orleans Investment Conference to discover new opportunities and strategies, exchange ideas, and plan for the coming year. To learn more about today's investing environment and updates, join Mark Skousen, Peter Schiff, Brian London, Robert Kiyosaki, Doug Casey, and dozens of other experts at this year's event from the 1st to the 4th of November. Go to neworleansconference.com to register today.
And, in your last letter, you also talked about the cyclicality of markets and how that differs from the steady advancement of science and technology that's, cumulative, but markets are always cyclical. It seems to me that in this modern age, and particularly, I look at 1971 when they closed the gold window as the day that they handed the whiskey and the car keys to the central bankers. Like teenagers, they jumped into their car and they immediately ran it off the road in the 1970s. And then they became a little more circumspect about it. But still, they kept creating debt, kept creating money in ever-increasing quantities. And their purpose was not so much to create the booms, but to cushion the bust. And yes, they did want to create wealth effects, most recently in the last two cycles, to create at least wealth, if not booms. But the end effect is that they're taking these cycles in the markets and they're trying to stretch them out. They're trying to lessen the pain, but in the process, they're also lessening the gain on the boom side. But does that really happen? Can they, if they try to ameliorate the pain of a bust, isn't that process alone just creating more of an upside on the boom, on the bubble side? The real question is, because they're flooding the markets, flooding the economies with liquidity whenever there's a bust or a downturn, and their goal there is to lessen the downturn, aren't they really also just blowing up the bubbles on the upside?
Well, Brian, Janet Yellen, the Fed chair but one, gave a talk at the Brookings Institution just the other day. And in it, she said that what central banks ought to do is to work to create booms in the wake of busts, to compensate for the loss of employment and output during the downturn. They ought to rather bend over backwards to stoke things to the upside, which I thought was an extraordinary. Well, it's not the first. She's not the first central banker or former central banker to have prescribed this. Something like this has come out frequently from over the past several years, but it was a very explicit prescription for boom and bust on purpose. In the past, booms and busts recurred in the 19th century. They occurred every 10 years or thereabouts. They were regarded as something natural, much like an earthquake, I suppose, but something that was rather to be regretted. And now, of course, this is working its way into explicit Fed policy. Yeah, they treat recessions as if they serve no useful purpose. But in fact, during a downturn, what happens is the bad companies go out of business, and better companies reorient themselves and restructure. It's not as if cyclical downturns in a market economy are without a purpose, and to suppress those downturns, to perpetuate the lives of marginal enterprises, is to consign us all to the loss of dynamism, which is actually one of the problems nowadays. The most uncharacteristic loss of spirit, of dynamism in the U.S. economy. Some of that's been reversed in the past year, but not all of it.
Exactly. It's like they're taking aspirin to tamp down the fever, but they're not prescribing penicillin to get rid of the infection. And, you talk about central bankers coming out and saying this after they're out of office, as it were. I had the opportunity a few years ago to sit down with Alan Greenspan when he spoke at our event. And I just wish you were by my side, because you could have definitely asked more intelligent questions. But I probed him about the federal debt and the implications and debt held by the public, et cetera. And in Greenspan, he's such an interesting guy anyway. His whole evolution from radical gold bug into, central banker and within the whole system. And then once he got out, he just reverted back to radical gold bug and gloom and doom. just almost immediately as he stepped foot outside the office. So he really, when I was talking to him, he was not unlike many of the speakers that walked up to our podium that day. And he recognized the problem with the debt and everything else, of course, the debt he helped create. But his point was, he says, all of that pales in comparison to the derivative exposure of the too big to fail institutions. And he says that under Dodd-Frank, the U.S. has essentially guaranteed that derivative exposure, those derivative liabilities of the too big to fail institutions. And he says that total not only dwarfs the federal debt and entitlements, it's incalculable, even by those institutions themselves. So, that was his belief that was the biggest risk we face right now.
I can't wait to hear what Jay Powell says when he's freed up the bonds of office.
Yeah, he's a bit of a straight shooter too, on a relative basis at least.
Yeah, yes, he apparently is a native English speaker. It's possible to follow him, unlike some of his predecessors.
As a first language. Well, what do you think the implications are of our debt? In Gold Newsletter, I've been preaching, I guess, that the debt load we have today in the U.S. and really in all of the developed countries is too large to be addressed by anything other than some significant depreciation of the currencies, and that gold is virtually guaranteed to rise over the long term because of that. I mean, just the near term that's in doubt, but the long term seems fairly certain in my view.
I agree with that. I also think that it's a very difficult thing for even the most patient investor to deal with a necessarily undefinable time horizon. The inevitable is certain, but it's not necessarily punctual. And all of us are given an allotted number of heartbeats, and naturally we would like to have the pleasure of dying rich. I think it was Adam Smith who was prodded by a younger companion of his, a younger acquaintance, and this young fellow was very much concerned over developments in the American War. This was in the 1770s, and he taxed Smith with the errors of British public policy and with the debts that King George III was building up and prosecuting this seemingly pointless war, and what would become of us, says this young chap. And Smith says, in more or less these words, there is a great deal of ruin in a nation, and ain't it so? I mean, I have a collection of books forecasting the financial end of America as we know it. Observe, please, Brian Fergus, that nothing like that has yet occurred. With the dead clock ticking away, was it 21 trillion now and change? A lot of change, to be sure. I don't know when the inflection point comes. What I think I do know is that on offer this year from the Federal Reserve and from the projected emissions of the Treasury itself, on offer to the bond market is the greatest volume of federal securities as a proportion of GDP since, I think, 1945. That is, supply from the Fed and from the Treasury as a percentage of GDP is the greatest since the close of the Second World War. And this is a time for this period, it's a very rigorous, very brisk economic growth and sky-high asset prices, and yet this government is showering, flooding the markets with treasuries. And you wonder, what is the demand for this paper at these interest rates and at this dollar exchange rate? And will not people reconsider their allegiance to bonds as the first and most desirable port in a storm? Bonds are promises to pay in the currency that central banks can create with a flick of a switch. And I think some of us are born to doubt that the efficacy of this system. You come out your first day of school, your age maybe 4 or 5, and you say to the teacher, well, isn't fiat currency necessarily prone to debasement? And the teacher looks at you as if you're crazy, and that look becomes familiar for the next 60 or 70 or 80 years, depending how long you live. You are born with the deep-rooted suspicion of this kind of a monetary system. Certainly, I feel as if I'm this member of this company, and come not necessarily doubt your senses, but you come to doubt that you will live long enough to see the resolution of these self-evident contradictions. I hope we all do live long enough, but I am only, I guess, seconding you in observing that the timing is most vexingly uncertain.
Yes, and yet the direction is, and is another point I've been making, and the currencies will grow ever cheaper, and there'll be more and more of them. And the question that investors need to know, perhaps not as speculation, but if they just want to ensure their wealth to some degree, they need to have some counterbalance in their portfolio of something that there isn't an unlimited supply of, or at least.
I couldn't agree more. I mean, I have been bullish on gold since 1945. I was born in 1946. I have had moments of which I was neutral on it, but never actually bearish, I think, over this time. I believe that the gold is not a hedge against monetary disorder, because monetary disorder exists right there on the computer screen. You can see it, or on the page 1 of the Wall Street Journal. It's there, so it's not a hedge against monetary disorder. It's an investment in monetary disorder.
Mm-hmm.
And I think that you will get paid very well in gold come the day in which the scales fall from the eyes of those who credit the central bankers with a foresight they don't have, and who credit paper currencies or digital currencies the staying power they surely don't have. What I can't explain, what I really cannot fathom, is the lack of curiosity on the part of even moneyed people about the nature of the currency in which their wealth is denominated. Some of the richest people, some of the most astute investors, seem never to give a thought to the nature of the dollars in which their wealth abounds. It just flummoxes me. I can't credit why they aren't thinking more about the nature of the medium in which they are storing wealth, so far as they're holding it in. Yeah.
And the irony is that these are very smart people, and they won't start thinking about that until the currency is worth much less, and those counterbalancing assets are worth much more relatively.
Yeah. Well, you don't. I mean, it is rather a presumption to say of Warren Buffett, for example, that if he only gives this matter some thought, he would see it our way. But let's leave Warren out of it and just say generally, without naming names, that I wish some of these people would just buy a little bit of gold. It would be most helpful to me personally. But in the meantime, you look around and what we gold bugs some of us a little bit dispirited at the moment. What we ought to reckon with is that our own sense of marginalization, perhaps our own sense of not being exactly in the mainstream of this great bull market and many other asset classes, this is building for, I think, a bull market of our own. I mean, you look at almost any sentiment measure of gold, and it's near rock bottom. The gold stocks are more or less orphaned. The volatility measures of gold are more or less comatose. So, I remind myself from time to time that these are not the signs of a top, right? These are, I think, the omens of a market that is going to come into its own. I can't tell you. My best guess is like 5 years ago. That's my best guess about when gold's going to take off. But I look around and I see how little investment interest it is attracted. I look at the bargains on offer, and I look at what the central banks are doing, and I remind myself that the gold price is really the reciprocal of the world's faith in these people, well-intended people, but surely misguided people who are running our monetary machinery. And I think, yes, this is value. So that's my story, and I'm sticking to it, Fergus.
Right.
Yeah.
I had one question. You say you're very cautious about giving timing to anything or any forthcoming recession or devaluation to the US dollar, perhaps. Can we look to other or to foreign central banks for clues about this, though? So, I mean, I know that I'm not sure. I see news articles report that Argentina and Turkey are having problems. I'm not sure whether that's even relevant. But what about the ECB, for example? Can they, by their actions, help to pressure the Federal Reserve in one way or another?
Oh, I don't see much constructive monetary. I don't see the ECB as a source of constructive monetary advice. I think, on the contrary, that the ECB's suppression of interest rates is setting up the eurozone for a lot of credit trouble. You can find speculative grade bonds trading at less than 2% in the eurozone. That's owing to Mario Draghi's buying program. Not so long ago, you could find them trading at less than 1 percentage point. So the ECB its program has been the distortion of interest rates and therefore the misdirection of capital. The story of the past 10 years has been an increasingly acrobatic, groping, reaching, desperately clutching for yield. All of that means is that we are surrounded by white elephants. Not sure which ones are the white elephants, but the businesses that have risen on the basis of cheap credit, the decisions taken based on the accessibility of bank debt and bank funding, all these things, you're not going to know which ones are actually the errors until the tide turns. But unless the wisdom and experience of the ages with regard to distorted interest rates, unless that's all wrong, the next downturn in business activity and the next crack up in credit, I think, will be very serious. And I think because of the gravity of the troubles that we are storing up on account of suppressed interest rates, that the central banks will be obliged to acknowledge errors, not to admit them verbally, but rather to backtrack in policy. And I think then, surely, thinking investors will reconsider their kind of unexamined acceptance of monetary doctrine and of the units of currency the central bankers have created in such profusion. So I think that I think that gold is going to shine against these currencies and against the doctrines of the central bankers themselves. So anyway, gentlemen, I seem to keep repeating myself, but I am bullish on the barbarous relic.
Sure. Do you have any final comments, Brian?
No, I think that's just typical brilliance by Jim, and I completely agree. So that makes me feel very good when somebody as smart as him, as he agrees with me. It's a matter of time, but we don't know when. Jim, I'm really so happy that you're participating in the New Orleans conference this year. We were able to mesh it with your schedule. I know our attendees look forward to it whenever they can hear from you, and you're going to bring more of your brilliance to our stage. Fergus, I think we should reiterate that special offer he's making to our listeners of free access to the audio-video recordings from his event for anyone who subscribes to Grant's Interest Rate Observer, and we'll definitely put that link up on the show notes.
Yeah, so his website is grantspub.com, but if you go through our own show notes, you'll then have access to that special. So that's just goldnewsletter.com/podcast. Otherwise, Jim, I'm excited to see you in New Orleans as well. Thanks again for sharing your time with us.
Well, it'd be a pleasure, and I thank you both. You're very generous.
Cheers. We'll be in touch.
Thanks, Jim.
Okay, bye.
Bye-bye.